Transfer pricing is a profit allocation method used to attribute a multinational corporation's net profit or loss before tax to countries where it does business. Transfer pricing results in the setting of prices amongst divisions within an enterprise. Transfer prices are charges for goods and services between controlled or related legal entities within an enterprise. Legal entities considered under the control of a single corporation include branches and companies that are wholly or majorly owned by the parent corporation. Transfer pricing is a great way to move goods from one company to another division or department to another without generating a lot of postings on the account receivable and account payable books. The value of goods is simply moved from one division to the other, a process that greatly simplifies the process. Normally, there is a simple form that accompanies the physical transfer of goods, and it is used by both the sender and the recipient to make appropriate posts in the accounting records of the company. This process eliminates the necessity for invoices, tariffs, internal bills of lading and other documents that would normally apply to a new purchase using an outside vendor. While main purpose of transfer pricing is to enhance the overall value of the corporate, there are instances where this type of transaction is abused. This is especially true when the transfer in international locations are conducted. Today, many countries have regulations to help prevent the use of this pricing method as a means of evading taxes or similar unethical and illegal activities. Concept of transfer pricing. Transfer pricing is a profit allocation method used to attribute a multinational corporation's net profit or loss before tax to countries where it does business. Transfer pricing results in the setting of prices amongst divisions within an enterprise. Transfer prices are charges for goods and services between controlled or related legal entities within an enterprise. Legal entities considered under the control of a single corporation include branches and companies that are wholly or majorly owned by the parent corporation. A transfer pricing is that notional value at which goods and services are transferred between divisions in a decentralized organization. Transfer prices are normally set for intermediate products, which are goods and services that are supplied by the selling division to the buying division. The goods that are produced by the buying division and sold to the outside world are known as the final product. The price charged to the interdivisional transfer of goods and services is revenue to the selling division and cost to the buying division. Therefore, the price charged will affect the profit of both divisions. Benefit or revenue to one division can be created only at the expense of the other division. For example, the selling division will benefit from charging prices for such transfers of goods and services. However, for the buying division, this will result in higher costs. Therefore, transfer prices can be impact on the evaluation of each division's performance and measures applied for such measurement of performance.
A company has two divisions, A and B. The division A is currently operating at full capacity. It has been asked to supply its product to division B. Division A sells its product to its regular customer for rupees 30 each. Division B, currently operating at 50% capacity, is willing to pay rupees 30 each for the component produced by Division A. This represents the full absorption cost per component at Division A. The component will be used by Division B in supplementing its main product to conform to the need of special order. As per the contract terms of sale, the buyer calls for reimbursement of full capacity to Division B plus 10%. Division A has a variable cost of Rs 17 per component. The cost per unit of Division B subsequent to the buying part from Division A is estimated as follows. Purchase parts outside vendors Rs 90. Purchase part Division A Rs 20. Other variable cost Rs 50. Fixed overhead and administration is Rs 40. The total is Rs 200. The company uses return on investment in the measurement of division and division manager's performance. A. Manager of Division A, would you recommend sales of your output of Division B at the stipulated price of Rs 20? B. Would it be in the overall interest of the company for Division A to sell its output to Division B? C. Suggest an alternative transfer price and show how it could lead to goal concurrence. The solution is A. As manager of Division A, sales at Rs 20 per unit to Division B should not be recommended. The division is already operating at its full capacity and the market is presumably absorbing all its output at Rs 30 per unit. B. Decision analysis whether to transfer part from Division A to Division B of Rs 20 unit or not. The particulars are sale price of Division A, which is sold externally at Rs 30. The sale price for Division B is Rs 200 plus 10%, which is Rs 220, less the relevant incremental cost, which is for part of Division A Rs 17 and for B it is 17. Purchase parts from outside is 0 in case of sold externally. It is 90 in case it is transferred to Division B. The other valuable costs are 0 in case of externally sold goods. In case of goods transferred to Division B, the other valuable costs are Rs 50. Profit per unit are 13 and 63 respectively. It will be in the overall interest of the company that the transfer takes place as it would increase the firm's profit by Rs 50 per unit. C. Dual price basis of effecting transfer is the most appropriate. In this case, the relevant transfer price will be Rs 30 sale so far as Division A concerned and Rs 20 purchase so far as Division B is concerned. It will keep the profits of Division A unaffected and will facilitate the utilization of idle capacity of Division B as also increase its profit. The sale price would be 210 plus 10%, which is Rs 231, less cost of Rs 90 plus 50, which is 140. The sale price is Rs 210 plus 10%, which is Rs 231, less the cost of Rs 90 plus 50, which is 140. The net profit is 231 minus 140, which is 91 rupees.
Let us now recapitulate what we have learned in this module. Transfer pricing is a profit allocation method used to attribute a multinational corporation's net profit or loss before tax to countries where it does business. Transfer pricing results in the setting of prices among divisions within an enterprise. Transfer prices are charges for goods and services between controlled or related legal entities within an enterprise. Legal entities considered under the control of a single corporation include branches and companies that are wholly or majorly owned by the parent corporation. The price charged to the interdivisional transfers of goods and services is revenue to the selling division and cost to the buying division. Therefore, the price charge will affect the profit of both divisions. Benefit or revenue to one division can be created only at the expense of the other division. Transfer pricing should be in the accurate measurement of divisional performance or profitability measurement. Transfer pricing should motivate the divisional managers into maximizing the profitability of their division and making divisions that are in the best interest of organization as a whole. Transfer prices should ensure that divisional autonomy and authority is preserved. Transfer prices should also allow goal congruence to take place, which means that the objectives of the divisional managers are compatible with the objectives of overall company. Market price refers to a price in an intermediate market between independent buyer and seller. When external markets do not exist or are not available in the company, or when information about external market prices is not readily available, companies may decide to use some form of cost-based transfer pricing system. Variable cost-based pricing approach is useful when selling division is operating below capacity. Negotiated prices are generally preferred as a middle solution between market price and cost-based price. Under negotiated prices, the managers involved act in the same as the manager of an independent company would. Under dual pricing of transfer pricing, selling division sells the transferred goods at a profit using full cost transfer price for the buying division is the market price. The difference in transfer price for the two divisions could be accounted for by special centralized accounting.